This is an example of long-term contracts where we have a positive overall gross profit and we have positive gross profit in some years and an interim negative gross profit. And this is the example that I've used before, but our contract price is $550. Our cost, the estimated cost to complete at the outset, are $400. So the first thing we're going to do is estimate year one revenue and expense. Even though our target is year two, we have to figure out how much did we recognize in year one, because we subtract year one from year two in order to get the year two amounts to recognize. Let me show you. For year one, we were 1/4%, one quarter complete. That is, we had 100 incurred of a total estimated cost of 400. That is the 100 plus an additional 300, or 25% complete at the end of year one. We multiply that 25% times the contract price, and we're going to recognize as revenue in year one $137,500. We incurred $100,000 of cost, so our year one gross profit is $37,500. Then we move to year two. We are now 60% of the way complete. That is, we have incurred $300,000 of a total of $500,000. We're estimating $300,000 plus another $200,000, or 60% complete. And so we multiply the contract price times 550,000 times the 60%. And by the end of year two, we should have recognized $330,000 of revenue. We subtract what we recognized in year one, $137,500, and we have additional revenue to recognize in year two of $192,500. Notice that we incurred $200,000 more in year two, and our total cost is $300,000 minus what we incurred in year one. So we have a negative gross profit in year two, $7,500. $192,500 minus the $200,000 of costs incurred in year two. To look at year three, by end of year three, we're going to recognize 100% of the $550,000, and we're going to subtract the revenue that we've recognized previously, $330,000, and that gives us the amount of revenue to recognize in year three. We subtract the cost incurred in year three, that is the additional cost of $500,000 minus what we had over $300,000. The additional cost is $200,000, and we have a $20,000 gross profit in year three. Let's look at a summary of these numbers. Year one revenue, $137,500, and gross profit $37,500. Year two, $192,500, and negative gross profit of $7,500. In year three, revenue of $220,000 and $20,000 of gross profit. When we add these up, this adds up to the total contract price of $550,000. And we know that the total costs incurred were $500,000 by the end of year three. And so 550 minus the 500 is $50,000 of gross profit, allocated mostly to year one. Subtract from year two the 7,500 loss. That gets us down to 30 plus the remaining 20,000. Our total gross profit, $50,000. And there you have an example of overall positive gross profit, but a negative gross profit in an interim year.